Depreciation. Having given you the background of what are the assets, how the assets are used, what are the associated costs, we take up to the value of the depreciation. Non-current fixed assets are gradually used up in providing goods and services over a period of time. That is the definition of fixed assets. Fixed assets are those assets which are not used up in a single year but are gradually used up in providing goods and services or in generating revenue over a period of time. The purpose of accounting depreciation is to spread the cost of fixed assets over its expected useful life in the best possible manner. Depreciation is a method of allocating costs. Depreciation itself is not a cost which you incur by payment of cash. In fact, it is a notional cost. Alright, it is not a paid cost. It is a distributed, allocated cost. The original cost is of course a machine. But since the machine cost is a capital expenditure, we allocate that capital expenditure over a period of time by a term known as depreciation. Achieves the matching cost principle. Matching cost principle says that you match revenues, receipts with revenue expenditure. So, by charging depreciation to the revenue receipts income, you are actually using the matching principle. So, you are achieving the matching cost principle's objective of matching only those expenses which pertains to current year. In historical cost, traditional accounting, net book value is the result of calculations. Say for example, let me explain to you by this. Let us say for example, you have bought a machine worth say 50 lakhs. And in a particular you have charged a depreciation of rupees. So the net value will be 48 lakhs. This is the net book value or net value. Original cost minus accumulated depreciation. Now, next year, this is a first year. Next year, 50, again same original cost. But next year, the accumulated depreciation will be 4 lakhs. 2 lakh for last year, 2 lakh for this year, total becomes 50 lakhs. So it becomes 46 lakhs. It is not intended to represent the asset's market value. This 46 lakhs is not the realizable value or the market value or the value which you can sell. That is not our intention. Our intention is to distribute the original cost of 50 lakhs every year, slowly, gradually, depending upon its useful life. So first year we reduce 2 lakhs. So the total accumulated depreciation becomes 2 lakhs. Next year we charge another 2 lakhs, it becomes 4. The next year it will become 6. So if you see the net book value will become 48, 46, 44, 42 like that. Ultimately the last year, at the end of 25th year, it will become 0 and the asset is thrown out, disposed of, right? You see in these blocks, I am using the accounting equation in front of you. Assets minus liability is equal to ownership interest. The accounting equation we say assets equal to ownership interest plus liabilities. But in order to explain to you the depreciation, I am using this equation, and on the left hand side you see I am using the equation assets. So when you depreciate, you saw in my earlier example, it gets reduced. First year is by 2 lakhs, second year by 2 lakhs, third year by another 2 lakhs. So by third year, 6 lakh you have reduced, right? So these assets minus liabilities. Okay. The accounting equation is assets is equal to liability plus ownership equity. Now this liability, if I take it in the left hand side, it will show a minus sign. Minus, I say, minus liability is equal to ownership. Ownership equity is what is written as interest. Right? So whatever is the amount of depreciation, what I showed you is that whatever is the amount of depreciation, 2 lakhs will be charged to profit loss account. If you charge to profit loss account, the profit gets reduced. So owner's interest is also gets reduced. So that is why these columns of reduction. These are meaning revenue expenditure, which reduces the equity, because any reduction in the profit is to be reduced in the owner's equity. Any increase in the profit increases the equity. This is what the accounting equation, that is what is described. So what is the impact? The other way of showing the in profit loss account. So if you see the profit loss account, we will show you depreciation here in a particular year 2 lakhs, and here we will say this is balance sheet. In the assets column, you will write net book value of assets is a 50 lakhs less depreciation. Less depreciation 2 lakhs. So net book value is 40. Net book value at the beginning of the year was 50 lakhs. 2 was depreciation. 48 lakhs is a net book value when you prepare your balance sheet. This 2 lakh is taken here. This is the 2 lakhs. Right. I hope you have understood the depreciation accounting mechanisms. Right. Yearly depreciation and accumulated depreciation. In the example that I've given you, yearly depreciation was 2 lakh and it gets added up. It's called accumulated depreciations. See, frankly speaking, in balance sheet, when you show asset, there are two alternatives. One, you show the asset at the cost at which you purchase, and show the accumulated depreciation on the liability side. Keep on increasing the depreciation. Why do you show on the liability side to it? That much of expenditures have accumulated. You have not charged, you have not reduced the value of the assets. Right? But any reader of the balance sheet would know assets is the debit balance with 50 lakhs. Accumulated depreciation is a credit balance which has got 2 lakhs, 4 lakhs or 6 lakhs. If you combine them, the net book value will be arrived. Each year, a fixed asset is in use. A portion of its cost is deducted from the balance sheets. This portion of cost is matched against the revenue of that year. This gives the depreciation charge, which I have explained. The depreciation of the non-current assets or fixed asset in each year is added to the depreciation of earlier years to arrive at the accumulated depreciation. So if for a machine, if someone asks you how much is the depreciation so far, then you add the depreciation charge in the previous years till the current year, that becomes the accumulated depreciation. So you may show in the balance sheet of your thing. How do you calculate the depreciation? Three important things are required. Cost of the fixed asset. Cost includes all purchase price, and which I have already explained to you. What is the estimated useful life? You cannot precisely say how long it will be useful. So how much is the estimated life? 20 years, 10 years, 25 years, like that. The estimated residual value. So suppose you come to the end of 25th year, the estimated value. You are not going to use any machine now. You are going to buy a new machine, but you can dispose this off as a scrap or as a second-hand machine. So what is the value? Sometimes the machine may not cost you much, or sometimes it may cost you some amount. In which case, the depreciation will be cost minus this estimated resaleable value, residual value, right? The purpose of the depreciation of calculation is to spread the total depreciation over the estimated useful life. There are two methods, straight line method and reducing value method. Now, both the methods have got their own merits. Straight line methods has the depreciation equal on all the years. So, if you charge 2 lakhs in 1 year, it will be all the useful life will be 2 lakhs. Residual value will be a rate of depreciation that is applied on the net book value. That is, every year you reduce the value of the asset and on that you charge a fixed rate of depreciation. So, in straight line method, the amount of depreciation is same, whereas in reducing value method, the rate of depreciation is same. Not the amount, the rate of depreciation is same. So, we shall see the calculations in under the both methods. Those who believe that fixed asset is used evenly over a time period, like for example, building you construct, you use it this year, next year is going to be same more or less, with little repairs here and there. Land, for example, furniture, for example, right? So since these types of machine are evenly used over a period of time, straight line depreciation is very useful. But not for machine, because every time you use it, its value gets reduced. So you cannot say it is evenly getting reduced. We shall see a very important point when we come to the machineries. How do you calculate the straight line depreciation? Cost, I have already told you, minus expected residual value. At the end of the useful life, if you expect some residual value, put that estimated amount. If you do not know, or if you think it will not have any value, put it 0. So the total cost divided by the expected life. 10 years, 15 years, these are all technical assessment. No accountant's job. Technical assessment is given. So total cost is 50 lakhs. Expected life is 10 years. So 50 lakhs by 10 years will become 5 lakh every year's depreciation. Straight line depreciation, a fixed asset which has a cost of 1000 and an expected life of 5 years. The expected residual value is nil. The calculation of annual depreciation charge will be as follows. Rupees 1000 is the cost minus nil, no residual value, divided by useful life 5 years, it gives you 200 rupees per annum. So the depreciation will be 200 rupees per annum. Now comes the accounting policy. If you recall, I discussed with you, accounting policy is a decision of the management. Accounting policy in this case will be depreciation charged on a straight line basis at a rate of 20%. For 5 years means 20% of the cost per annum. Now, this shall be the accounting policy. In some other company, if they expect the residual value to be 200 rupees or the expected life is 4 years or 6 years, accordingly, the amount will change, the rate will change, the accounting policy will be different. Straight line, a graph of the net book value of the asset at the end of each produces a straight line, for example. So this is the example that I have given you, pattern. The original cost is 1000 rupees. So first year depreciation is 200. So total depreciation is 200, accumulated depreciation. So the net book value becomes 1000 minus 200, 800. Next year's depreciation is 200, accumulated depreciation now increases to 400 rupees. So therefore 1000 minus 400, it becomes 600. Right. So you can get 600 by reducing 200 from 800 also. So you can take this from second year onwards. You can reduce this 200 from this and you get this, or reduce 1000 from 400 you get this. So the total original cost minus accumulated depreciation or the net book value, net cost minus the current year's depreciation will give you the balance of the things. So third year is 200 becomes 400 net book value. Fourth year again is 200 depreciation. Accumulated depreciation is 800. 1000 original cost minus 800 becomes 200 rupees. Last year, the depreciation is 200. The total depreciation accumulated becomes 1000. So the book value becomes nil when you dispose it off. All right. Now, some of you might ask a simple question that suppose at this time, the residual value at the end of the fifth year, say 200 rupees. Now, that 200 rupees will become the profit for that year. Right? This is the depiction in that straight line. You see the straight line depreciation because every year's depreciation is the same. So the amount of reduction in the book value is same 200, 200, 200 every year. This is correct assumption regarding assets like building, furniture, etc., which are expected to be used evenly during the period of time. Right. Generally, in these type of assets where straight line depreciation is done, you do not incur much of repairs. So you will see that repairs is also like whitewashing, will also be constant. But more interesting thing is when we take up machinery, where we use the word reducing balance depreciation. Those who believe that the non-current fixed assets depreciates faster in the earlier years because you tend to use it more vigorously. And as the machine gets older and older, you use less because its production capacity reduces. You might get another machine also, but till it has a useful life, you keep on using it. So therefore, depreciation has to be higher at the initial years and less in the years. Unlike in a straight line depreciation, which the depreciation is equal. If you take a machinery which produces say 1000 units per day, after 10 years, you will see that it will be producing 800 or 700 units per day. So therefore, logically, initial years which produces 1000 units per day should have more depreciation because you are using it more vigorously. And when you come down slowly to 800 units per day, your depreciation must reduce. So for this, what we do is a rate of depreciation is calculated by statistical table, keeping certain assumptions. And that rate is applied to the net book value, not the original cost. Original cost is only for the first year. From second year onwards, the balance original cost is reduced by the depreciation. You get what is known as a net book value or the reduced balance of the machinery. And on that, you apply the same rate, but the depreciation will be of a lesser amount. This is the formula to calculate the rates. But of course, you need not calculate. These are all available nowadays in a statistical tables. N is the number of years of useful life. Nth root. If 2 years, square root. If 3, the third root, like that. The estimated residual value and the cost of the assets. Estimated residual value or 1 minus this multiplied by 100 will give you a fixed rate of depreciation. Right? I'm again repeating, you need not learn calculating this unless of course you are a student of mathematics and statistics, which you can easily understand. In normal questions of accounting, the accountant is given the rate which is calculated. Example for calculations, 5 years, 1000 rupees the cost, residual value is 30 rupees. This is how 1 to the under root of minus 5 instead of the square root of this, and 30 over is what is called, this is correctly speaking 1 minus, this should be correctly speaking minus fifth root. Okay, so this is mathematically calculated and you will get approximately 50%. ₹1,000 original cost, right? 50% is the rate, 500 rupees the first year depreciation, the net book value is 500. But you come to the second year, See the second year. Second year depreciation is 500 because no, second year net book value is 500 and the depreciation on that becomes 250. This 50% is charged on the net book value. 50% is charged. Therefore, you get first year you get 50% of 1,500. Next year 50% of 500. Third year 50% of 250. Fourth year 50% of 125. And last year 50% of 62 becomes 31. So net book value is 500, 250, 125, 62, 31. So depreciation is keeps reducing it. Net book value is keep reducing it. Alright. The only thing remains constant is the rate of depreciation. Alright. So this is how it's calculated. And very interestingly, you will see here the graph shows the reduced depreciation like this. Alright. Now, what happens in case of machinery for which reduced balancing depreciation is very important? You see, let me take you two important revenue expenditure every year, repairs and depreciation. For machinery, the repairs will keep increasing. Alright. First year it will be, let's say for example, the repairs was nil. Next year it will be 200. Third year it may be 400. Fourth year it may be 700. And last year it may be, by the time you are going to sell, it may be 800 rupees. Whereas depreciation, in case of machinery, depreciation will be 500. It was 250. It was 125. It was 62. It was 31. See? So therefore, if you see with regard to a particular machine, the total expenditure, that is, it remains 500 and it is 450. It is 525. It is 762. It is 831. Right. Now you see the total expenditure is gradually increasing. This is what it happens. Right. So the idea behind reducing balance depreciation using is in case of machinery, it's tend to be used less and less vigorously. So therefore its production capacity is falling down. Well, at the same time, the maintenance expenditure keeps increasing. If you keep a straight line depreciation, so depreciation will be constant, repairs is increasing, so total expenditure will go up. Whereas here, we are able to make a very slow increase in the overall expenditure. This is the objective behind reducing balance depreciation. There are some machines which charges 20%. There are some machines which charges 33%. For example, computer software whose life is not more than 3 or 4 years. In such cases, they divide 4 years into the total years and 25% of the total cost is charged as a depreciation. Alright. So different types of machines are given different types of rates of depreciation. In fact, Companies Act and Income Tax Act prescribes the suggested rate of depreciation for different types of machines used in a business house. Having discussed the two important methods of depreciation, we come to one of the very important objectives in a business with regard to fixed assets for which depreciation is charged. Fee income of rupees 1,20,000, pay wages and other costs 58,000, depreciation calculated at 10,000. How much may the owner take in drawings? Cash available is 60,000. Let us sorry for this thing, we can cancel this Let's go to the next topic. What I wanted to discuss with you is this. Let us say, for example, on January 1, two electrical instruments purchased a 3-year lease of a shop for ₹60,000. The accounts over the next 3 years would include the following items related to this lease. Lease means you've taken on hire, 3-year lease for 60,000, right? First year, it's just like acquiring a machine, right? First year, depreciation expense is 20, right? Why 20? See, 60,000 rupees divided by 3 years, so it becomes 20,000 each. So instead of 1,000, I'm just putting rupees 20, 20, 20. In the balance sheet, the original lease cost was 60, which is a fixed asset. Accumulated depreciation is 20, I get 40 net book value. Next year, the original cost is 60, the accumulated depreciation increases from 20,000 to 40,000. So 60,000 minus 40,000 becomes 20,000 net book value. Third year, the original lease cost is 60,000. Accumulated depreciation from 40 becomes 60. 60 minus 60, the residual value is 0. Your lease is completed. Your objective is over. Okay. Sometimes straight line with the residual value could be there, which I have explained to you earlier also. 60,000 minus 6,000 is 54,000 divided by 3, 18,000 will be the depreciation every year. That you can see it in this example of reducing it. Second year, income statement in the second year and the balance sheet second year and third year. Okay. Thank you very much. We have introduced to you one very important topic of depreciation, which is a very significant accounting standard discussed in both Indian accounting standards and international accounting standards. We will take it up another important topic in our next lecture. Thank you very much.
Thanks for watching. Do not forget to click the subscribe button and hit the bell icon. Do like, comment and share. See you next time. Subscribe and hit the bell icon.